All right, my people, welcome to another one. Today we'll be talking about fair value gap. Though I told us in the group that we'll be doing swing trading in our next topic, but I think it's just essential we know fair value gap since everybody understand how to draw the trend line already. You understand? So this fair value gap is just another way of taking a very perfect entry. It's part of the patience you need in trading, where you know that okay, when the market has gone to a particular point, it's coming back to a particular point. So I'm actually going to be going deeply into the fair value gap scenarios and how it goes, and we'll be checking on the chart. You understand how to spot them, how to find them, the time frame, how it forms, color candles, for the bearish, for the bullish, and all. So we are going to be going extensively and hard on this one. So now for fair value gap, okay, we need to start something. Okay. So for fair value gap, I just want to make sure that we have fair value gap, you know, something like this. We go something like this here. So this is the topic, the fair value gap. So it is an imbalance in price action created when a candle moves aggressively in one direction, skipping over price level. I'm going to take that again. This is an imbalance in price action. You understand? When market is just going, that green and red candle, those are the price actions just going up and down, moving, consolidating. Those are the price action created when a candle moves aggressively in one direction, skipping over price level. I'm going to just demonstrate that a bit here. You just have a market going this way, it's respecting an higher low, higher high, just go. Then at a point, the market just move like this. You know, something is there like is unusual. There's something here unusual. That's not the normal way of the market. You were expecting it to just be going this way, this way, this way, this way, this way, this way, this way. But at a point, it just went off. It went up like that, and it's just you just be like, what is this? An aggressive move. You understand? So skipping over price level, then it shows a lack of trade between buyers and sellers at the price range, something like this, just like this place, now. This particular side, you know this particular side shows a lack of trade between buyers and sellers because buyer just went up like that without any prior notice. You understand? So often forming a gap between candles. That is, this is a gap, this is another gap. The market was expected to be going just like this, just like all these places, but it just reached and went up like that. So there was a gap, it just went again, and it's just created another scenario. So now, often leaving a gap between candles. You understand? So these gaps are prime areas where price may return to rebalance. I always mention like fair value gap and imbalance. We're actually still going to do the two, but it's not hard to know. And you can only choose to trade one of them depending on the kind of capital you are holding and depending on the kind of trader you are. You understand me? So now we'll be going to how they form. I'm going to represent this on the chart itself. This will be on the chart itself. So how it forms, they occur when three candle pattern forms. This, let me draw a candle. Let's say we have one candle here, we have another candle here, you know then we have another candle here. Oh, that's not a candle, man. That's is that not pentagon? So okay, we have three candles here already. Are you getting me? So they said it occurs when three candle pattern forms. So something like this scenario, we can expect a fair value gap. You understand? In somewhere like this. So now the first candle moves in one direction. That is this. Okay, let's do this. This particular one now moves in one direction. This is an uptrend. Actually, this is a bullish. So the first candle moves in one direction. Then the second makes a large impulse move. That is, this second candle now is just excessively longer. You understand? This second one, just the second candle makes a long impulsive move. Just went like that, strike up. Then the third candle continue in the same direction. So this is our third candle here. This one continue in the same direction. You can see that it is an uptrend market. They continue in the same direction. You understand? So now the third candle continues in the same direction or consolidates. So the gap is between the weak low of the first candle and the weak high of the third candle in a bullish move, and vice versa. That is, the gap is between the weak low of the first candle and the weak high of the third candle in a bullish move. But in a bearish move, the gap will be between the weak low of the third candle and the weak high of the first candle. This is just it. I'm coming. Let's do something like this. I drew for, so this is for the this is a bearish. Are you getting me? So this for the bearish. This is what it means here. This the pattern. I'm not even doing it well here, but we're going to get it on the chart anyway. So, and the time frames that are used for the fair value gap, the best used time frame is the 15 minutes and the 1 hour. That is the one I use. I make use of the 15 minutes and the 1 hour. You understand? Especially that 1 hour, I make use of it a lot. And we are still going to do something like retracement. How to trade the retracement, that is the 4 hours confirmation exactly itself. I'm going to do that, but now we are still on fair value gap. So now the best used on it is best used on the 15 minutes time frame, the 1 hour time frame, the 4 hours time frame, the daily time frame. Depend on the kind of trader you are. But for me, I make use of the 1 hour time frame most of the time. Like 90% of the time, make use of the 1 hour time frame. So now the lower time frame can show noise. I always talk about can show noise. That is, I don't like trading on the lower time frame because sometimes it give you fake precisions. You understand me? So the higher time frame are stronger and they are more reliable. Are you getting me? And some people might ask that, sir, does the candle color matters? No, the candle colors does not matter. The color does not matter. What matters is the structure and the wick placement. You understand? It's how it forms that matters. The location of the high and the low that forms the imbalance. The location that forms the gap between those stuffs, those are what matters. It's not even about the color or whatever. As long as you know that you are in a bearish or you are in a bullish move, and you can spot that this market has moved aggressively at a direction at a particular time. Are you getting me? So now, how to locate the FVG? You look for 3 candles, just like I've explained. This one is for the bullish. This particular place is for the bullish. This particular one is for the bullish. So you look for 3 candles. The low wick, the strong bullish move. Candle 1, you check from the low wick, the strong bullish move. I'm going to do all this on the chart now. We'll be going to the chart now. And for the bearish too, you just, but it's not something hard. I'm going to do this on the chart itself in this same video. So now, how to use the fair value gap? Wait for the price to retrace into the fair value gap and show sign of rejection. Wait for the price to move or to retrace into the fair value gap and show sign of rejection. We are going to do that on the chart itself. So directional, entry, the direction, the exit, we'll be doing all that. And when to use fair value gap? When to use fair value gap in trending market or after a break of structure. You understand? After a break of structure or in a trending market. But for me, I trade it anyhow it comes. I trade it in change of character, in break of structure, or in trending market. As long as I know that I want to take another entry. Maybe I'm in a trade already and I want to pick another entry. I make use of my fair value gap or my imbalance, anyone that you want to trade. So, and the fixtures of the fair value gap, they act like a magnet for price. That is, they will attract the price back to come and fill that space, like it's a magnet. Then they show imbalance. They show you where there is a gap, where something is lacking, where buyers and sellers, where buyers and sellers are not agreeing. You understand me? A lack of trade between the buyers and sellers, just like I defined it. So they works well in synthetic indices due to algorithm behavior. Like I said, synthetic is computer generated algorithm. So in synthetic indices, the fair value gap is a very good one. Are you getting me? So those are the features of the fair value gap. And I already dropped the pictures, the diagram for fair value gap for the bullish and for the bearish. And I believe everybody has that. So for now, all fair value gaps are imbalance. I'm going to define an imbalance. An imbalance in general term is any price movement that shows inefficiency, where buying or selling was one-sided. It's like the same thing, but I'm going to show us what an imbalance is and what a fair value gap is. Are you getting me? I'm going to show it. So it's like the same thing. So all fair value gaps are imbalances. Every fair value gap you see is also an imbalance, but not all imbalances are fair value gap. It's getting twisted over there, like all fair value gaps are imbalanced, but not all imbalances are fair value gaps. But I'm going to get to that. Like I said, you can only choose to trade one. It's either you trade imbalance in a trade or you trade fair value gap. So now, and for imbalance, we are now in imbalance. Or maybe I need to do a thing for the fair value gap first. Let's do this. Okay, now let's say, okay, very good. I mean, this is volatility 10. This is V10. Okay, I'm going to mark out a scenario here. You see these three candles, these three green candles. 1, 2, 3. Okay, let me pick it from the down. I just hope everyone is seeing this. You see these three candles here, like this. These three candles. We have one, two, three, 4 candles here. So this is where you get your fair value gap. I'm coming. This is an example of a fair value gap. You can see the candles here now. So in this space now, you see that this 1, 2, 3, 4, the price just moves aggressively. It's not like the price is not moving like somewhere around there. It's not moving like something around there. See here, you see here the market, you can see that the buyers and sellers are just doing some things. They are agreeing to each other. There's no space in between them. I know it still look confusing to some, but we are going to explain it now. But here you see that this price just move aggressively. This 1, 2, 3, 4, it just went up like that. You understand me? So now this is how you get your fair value gap. You already know that if the market should go this way, there is no way the market will not come back to fill it. Now you can be scared that, oh, this market has moved aggressively and is buying. You just need to get into the buy. You want to take part of the profit from the market. But no, that's why I said patience is the greatest strategy in trading. Even if you have good capital, your patience is even the greatest, not even one of the, is the greatest strategy in trading. Are you getting me? So now you have something like this, and okay, I'm going to be needing my lines here. Okay, now so this is on the 1 hour time frame. You see I marked out this week here. This is for the bullish market. I mark out the week here. I already marked out the week. And okay, I think I'm going to read the rules again. I'm going to read us the rules again. Okay, the first candle moves in one direction, then the second candle makes a large impulse move. Okay, the third candle continues in the same direction. Those are how it forms. But now they said the low week. Now we are in a bullish market. Right? So now the low week, number one, this is candle 1. The low week, are you getting me? I'm coming. I think I need to drop. I need to drop just a diagram for us. I think I'm going to be doing that on candle labeling. We are going to be needing that. We are going to be needing that. We are going to be needing that. I think I need to do that. Okay, let me first explain what this whole thing is here. Just wait. Let me explain it. Let me label a candle. Let me label a candle. Okay, let's say um okay, I'm coming. I want to make sure that we're on the same page here. Okay, this is let's say this is a red candle. Why is it not giving me the best shape? Should be giving me the best shape. Okay, now very good. So now let's say this is a selling candle. Are you getting me? Can I really get a color here? Okay, let me use crayon. No. Let's use red. Okay, let's say we have a red candle here. Are you getting me? This is a red candle. Don't mind my this thing. So now in this red candle we have we are going to be having the up and the down. That is the wick. You know, this particular place, this one and this one is the body, but this one and this one is the wick. This one and this one is the wick. Are you getting me? I'm going to drop a diagram for that. We're going to drop a diagram for that. So now those are the wicks. And now in the selling market, this is the high. I'm coming. This is the high. HIGH. This is the high. Okay, this is the high in the selling market, or a selling candle rather, and this is the low. Are you getting me? This is the body. This place and this place, this is the body. Are you getting me? This is the body, and this is where the market opens for a sell. This is the opening. You know it's going down, so it started from here, and this is the close. I'm going to drop this image on the Telegram. So this is the close, this is the open, this is the close. Are you getting it? So this is a bearish candle. That is a selling candle, a sell candle. This is a sell candle or a bearish candle, anyone you want to name it. You understand? So since you know that this is the high, this is the low, this is the body, and this is a selling candle, this is where it opens and this is where it closes. So you don't really, you just have to make it an opposite like that for a buying candle. So let's do the opposite for a buy. Okay, perfect. So now we've got this, and let's say this is a buy market. Okay, let's say this is a buy candle. You understand me? So this is the labeling. I'm going to go like this. This is the wick. Okay, let's say I've got the wick here. This is the wick, this is the wick. You understand? This is the wick. So this is the buy candle. You remember this is a sell. This particular place is a sell. This is a sell candle. Are you getting me? So please don't make the mistake. This is the buy candle here now. So we've got something like this. Okay. So now I'm going to label this and this. This is the body. Are you getting me? This is the low. Oh, sorry. This is the high. I thought I was just talking about selling candle. And this is the low. Because for a buying candle, the market starts from this point. Are you getting me? So that is the high, and this is the low. And what else are we missing on? This is where the candle opens. You don't even need this low and high. You don't need slow and high. Just use the opening of the candle and the closing of the candle. This is where the candle opens anyway. I think it's better like that because it will be confusing. So this is where the candle opens. This particular place opens here. The candle opens here. This is the open. Are you getting me? And this is where it closes. This is the close. So this is a buy. This is a buy candle. I hope you are clear on that. So you already know a buy candle. You know where it closes and you know where it closes and you know when it opens, because it's going to be confusing on the chart. If I'm mentioning week high, week low, week this, week that, somehow you think I'm speaking in tongues. So there's no magic in trading. You just need to get the right information. There's no magic in trading. So now I've got this. This is my bearish. Then the low week. Okay, I've got something like this. And this. And the strong bullish move. Okay. And the higher close between candle 1 and candle 3 low. So you already know. Candle 1 and candle 3 low. Oh, why am I getting these issues? So you know that this is a fair value gap here. I don't know if you understand. Maybe I'm going to take another example. Because that one is 4. Maybe we should make use of where the market is just 3. This is on the 1 hour time frame. So let's make use of where the market was just, or is just 3. Let me make use of where I can see just 3. Okay, this is a selling market here. You see this 3 red, this 3 red. You can see that there is a space. I'm coming. You can see that there is a space here. The market moved without even letting any buyer buy anything here at this particular place. I don't know why I'm getting. You see, at this particular side now, you can see that there is a space. There's a space at this point. Okay, there's a space here now. You see the space, and that is why this market is retracing now, because the market is not supposed to retrace, but because there is a space, and I said it acts like magnet. There's a space here, you can see. So now this market is going to do like this. We have 3 candles here, right? So now what I'm going to do is I'm just going to get my first. This is my first candle. You see the open of this, or the close of this rather. This is a selling market. The close of this and this is 1, 2, and I'm just going to know that okay, there is a space in between these points. You see, so I can spot the fair value gap here, and I know that this market is coming. This market is coming back to this particular point now to fill this gap. It's coming to this point to fill this gap. I don't know if you understand. The market is coming to fill this particular gap here. You see something happen now. Something happened at this place, this particular side now. So the market came here and it came back to fill it. It came back. This place acted as a magnet, so it came back. And when this market was going as well, this one was just going aggressively like that. You understand? From this point now, it was just going down. So it left a space. And now this is what we have here. So I just have to mark it at the week. This close. You get me? This first candle here now, I just close it at the week. So now I can easily set my entry. And you can see that this market is even trying to come and test this line before selling down, because this is a selling market. I think I dropped this as a signal. It's in the signal group. This market is going to still sell. Are you getting it? I'm coming. Let me go back to H1. So this is just how fair value gap works. It's just a very simple concept in trading. So you can see that I'm still expecting this market to touch this my particular trend line, and I can see that a fair value gap has given me another confirmation for it. I'm expecting to touch this trend line, this particular one. I'm expecting the market to touch it, and now my fair value gap is even telling me that yes, I am right at that point. So now anytime I see that my market touches this green line, I sell down. So for the imbalance is just a space. Like now I'm expecting the market to come to this particular week here, this week now. I don't know if you are seeing this thing. For here now, I'm waiting for the market to come to this week, this particular candle, now that is on this one. I'm meant to come to the week here, to come and test the week. But for imbalance, we have three candles here now. We have one, we have two, we have three. But for imbalance, it will not come to the week, but it will come in between this place, in between that space. It will just come there and just start going to the normal direction. But me, I prefer fair value gap than imbalance, because it helps me in saving my money. You understand? I don't need to risk too much, because now imagine taking a trade from here and taking it from here. At least I can still save some token. Are you getting me? So that's just how simple the fair value gap is. Maybe with time you are going to get enough what's it called, we are going to get enough examples on that, maybe in the class. Are you getting me? So that is just how it moves. And impulse and correction, I think I said something about impulse and correction. Impulse is a strong directional move, or a directional movement in price that breaks structure or pushes the market significantly in one direction. Something like this. It's just like fair value gap as well. You see something that happened here now. See, the market just moved anyhow here. It moved anyhow, just moved aggressively. And the correction is the opposite. But maybe I'm going to take that as another class. The correction is the opposite. So the correction is a temporary or counter trend movement that retraces a portion of the previous impulse. That is a previous aggressively moved market or price action. So it won't really be hard as that. It's not really hard. It's not hard. So I just hope we understand all these little things. And psychological levels, I said something about psychological level when I dropped jump 75 sell. I said that place that I marked should be your normal TP, but I'm trusting the trade to move more than that to that down trend line. So psychological levels, let me just define it. There are levels or areas where price get to and pull back. You understand? That is like a strong resistance or support. I don't know if I can get. I think it's up 75. I dropped, right. Okay, the trade is even selling already. That's crazy, man. Okay, now now this is a psychological level. This place, you see, it touched this line. You see this line. See this particular place. You will see that this is 1, this is 2, this is 3, and this is 4. That place is very very strong. That place is very strong. This particular place, you see, that it touched my trend line. It touched my trend line now here. And I always tell you that wherever the market touches the trend line should be your normal TP, because it's a strong zone. So just imagine here now, you can see this is 1, this is 2, this is 3, this is 4. It touched it like 4 times. So hopefully it's going to break it this time. It's going to break it this time. So that's that about this. You understand? So that's psychological level. And the main message of this message is the fair value gap. And I just hope you can understand. But as time goes on, maybe tonight in class, I'm going to make more examples referencing on that. You understand me? Thank you all for staying tuned, and I wish you the best. So make sure you still practice more on the trend line. That trend line is a very very compulsory. I don't even know how to put it, but it's a very very compulsory one in trading. Please, that trend line is the backbone of technical analysis. Is the backbone. So once you know that you are doing technical, in this synthetic, if you don't know how to draw trend line, you are going to be really messed up. You can see how the trade is respecting all my lines like I'm a magician. You can see, you see, you see the way it's respecting everything. It's just touching it and just coming back. Are you getting me? So please and please and please make sure you understand these things perfectly. So thank you, thank you, thank you, thank you, thank you. That will be all for today.